Welcome to the first session on double entry bookkeeping. We will start with the chapter of partnership, but before we discuss the details, let us recap some concepts that we have studied earlier. Let us recap the various forms of business organizations that we have learned about in our previous classes. First one being sole proprietorship, which is more like a one-man show. The ownership rests with one person in this kind of an organization. But what happens, or what are the options, when there are more than one person who have to be involved as owners of the business organization? First option is to get into a partnership, sharing the assets, the expertise, and the efforts to generate profits that are shared as well. Next is the company format, whose shares, and shares I mean ownership rights, could be privately owned or publicly owned. The business group can also be a family-run business known as Hindu Undivided Family Business. This is probably the oldest form of complex business organization. We also have organizations that do not work for profits. They are known as non-profit organizations. Their motive is to serve the society or a particular cause. Hospitals and schools could be some examples. There are other forms of organizations also, but we do not need to discuss them here. In class 12th, we will be covering accounting methods and procedures for three of these business organizations: partnership, company, and non-profit organizations. Here we would like to start by learning about the partnership firms and the related accounting processes. Let us start with the theory part first. We start with partnership, its theories and concepts. We will try to understand what a partnership is and the legal and accounting aspects of it. Hi, my name is Amit Lawania. I have done BCom Honors from Kirodimal College, Delhi University, and PGDBM, which is an MBA, in Finance and Marketing from Ford School of Management in Delhi. Now, before getting into further details regarding a partnership firm, I would like to revise some of the basic terms that we will be using. Capital, profit, liability. Now, these terms will be used frequently in the lessons that follow. So let's just do a quick recap. Capital. Now this is the amount invested by a partner into the firm. Capital can be in the form of cash or any other asset that a partner brings to the firm. Profit. Broadly, profit is the net amount that a firm makes after deducting its expenses from the revenues. Profit remains the main objective of every business. There could be few exceptions though. Liability. Liability are the expenses that have been incurred and have not been paid. There could be short-term liabilities. These are the expenses that, as I said, which are incurred but yet to be paid. They have not been paid in cash or through check. They also include short-term loans. On the other hand, there are long-term liabilities that include loans that are payable over a longer period of time. The liabilities generally refer to the amounts due to the external parties. For example, loans, creditors, and bills payable. Starting our chapter on partnership, I would like to start with the definition. You need to mug this up, word by word. I repeat, please mug this up. What I have done here is I have broken up the definition in parts so that it is easier to learn. As per Indian Partnership Act 1932, Section 4, partnership is the relation between persons who have agreed to share the profits of a business carried on by all or any of them acting for all. Guys, this is 27 words. It's just 27 words that you don't need to mug up. If required, reverse the video, play it slowly, repeat if required, but mug it up. If possible, do it now. Having gone through the definition, let me explain the concept of partnership in a more informal manner. When two or more persons come together and join hands and agree to carry out some kind of a business, and not just any business, but a legal business. This could be a vocation, a profession, service, manufacturing. They synchronize their efforts and assets. They bind the partners by their decision with the aim of making profits, and profits that they share among themselves. Now, all these points that I have mentioned above make up a partnership firm. And also, these 5 points here are the characteristics of partnership, which we will discuss in the next slide. The points discussed can be formally divided into 5 categories, as I have mentioned earlier, and these are called the characteristics of partnership. Now, in your examination, question may ask for features or characteristics of a partnership firm, but your answer would remain the same. A partnership can have minimum 2 and maximum 50 competent persons. These persons have to be competent to get into an agreement. What does that mean? Who are the people who cannot be, who cannot get into an agreement? Let's see. A minor, a person who is below 18 years, any person who doesn't have a sound mind, or any person who is specifically disqualified by the law. Second point is the partners should be in agreement. That is, they should agree upon the terms and conditions regarding various aspects of business, structure, and legalities. This forms the very basis of the organization. Now, an agreement can be verbal or written, though a written agreement is always recommended. The agreement can be for a particular kind of business. It could be for a time period. It could be for a particular activity. Now, an agreement to carry out an illegal business, for example, a theft or a fraud, cannot be considered as a partnership firm. So, the business has to be a lawful business. The business can be a vocation, profession, service, manufacturing, but it has to be a legal one. And it has to be done to earn profit. This brings us to mention which activities are not included in this concept. Charity, because it is not done for earning profits. Joint ownership of any product, building or land, because there is no business activity involved. And unlawful acts do not qualify to be called a partnership. Profit sharing. Sharing the profits is another requirement for being called a partnership. The profits earned by the firm are distributed as per the agreement. Now, business, firm, and in a partnership is unique, where each partner can bind the other partners by his act. He can get into contracts on behalf of the firm and hence his partners. Partner thus work as an agent. That is, he represents and binds other partners through his acts. He is also a principal. That is, he is bound by the act of other partners. It is time we understand the nature of partnership in relation to the partners that form it. A partnership is not a separate legal entity. What it means is that partnership firm and its partners are the same. They are not treated separately. the personal assets of each partner, even if they are not owned or used by the firm, can be used to pay off the debts of the firm if required. The liability of partners is unlimited, and it is not just limited to the capital that is invested. Meaning, in case a firm goes bankrupt, that is, the partnership firm goes bankrupt, and the assets and receivables of the firm are not enough to pay the liabilities of the firm, then the personal assets of partners, I'm saying this again, the personal assets of partners, like his house, personal deposits, cash, car, jewelry, they can be sold, they can be auctioned, or they can be paid towards such liabilities. Now that we have learned about the separate entity and the liability of the partners towards the firm, let's take a look at the rights that a partner enjoys towards the organization. First, each partner has a right to participate in the day-to-day activities of the organization. Second, each partner has the right to be consulted for decisions made regarding the business or the organization. Third, the partner can check the books of accounts at any time, and he can even keep a copy if he likes. Fourth, the partner cannot be denied his rightful share in profit or loss. If a partner has extended an amount as loan to the firm, he is entitled to receive interest on it. This could be at a predetermined rate or as per the provisions of Indian Partnership Act. In case of emergency, a partner can take a call as per his best judgment and be paid back any expense that he incurs on account of such decision. The results may be favorable or not, that won't matter. A partner can deny adding a new partner to the existing firm, though he can leave the firm after giving a proper notice to the other partners. There can be instances when a partner carries out a business transaction from his personal funds. In such case, the partnership firm will have to pay such an amount back to his partner. The above 9 points can come into your examination as a direct question or a situation-based question. Read them again, revise them well, revise them before the exams, and there will be some easy marks for the taking. Now let us learn what an agreement is. Agreement can be verbal or written. A written agreement is called a partnership deed. Let's define it then. The written agreement between partners of a partnership firm is called a partnership deed. This is a one-line question that can come in your examination, so you may learn this definition again. See, it's easy marks for the taking if it comes. And the partnership deed is a legal document, which means it can be used in a court of law. It is signed by all the partners, and so its terms are binding on each one of them. Well, this comes in handy, especially if there is a dispute among partners at any time. Now, the partnership deed here is a very important concept, which we will discuss in detail now. Let's define partnership deed in easy words. The written agreement between partners of a partnership firm is called a partnership deed. It is a legal document that covers clauses relating to various aspects of partnership firm and is signed by all the partners. This is basically putting the agreement in black and white. So, is a partnership deed mandatory, which is a written agreement? Is it mandatory? No, it is not. But it definitely is recommended. Why? Because it covers all the clauses of the agreement in writing. This provides clarity and it ensures smooth functioning of the firm. It is a legal document signed by the partners, so it is binding on them, and especially comes handy in case there is a dispute among the partners. Let's have a look at the clauses. Every partnership deed covers clauses that form the basis of the partnership firm. The deed can have many clauses as per the requirement of the agreement. You need to learn some of them just in case a question pops up in the exams. Now, I have grouped them to make it easier to remember. For example, names and addresses, points relating to each partner, points regarding the firm, the clauses defining accounting policies, how will any changes in firm structure will be handled. And as I said, there can be many more such clauses. But I suggest that you learn a minimum of 10. Have you ever thought about what happens when the agreement, verbal or written, doesn't cover some of the important issues? Or if there is no partnership deed, that is a written agreement, and a dispute comes up? That's our next topic. Partnership deed or agreement, its absence. Now this is a very important concept. Let's have a look at the situation again. 1. Either there is no written agreement available and there is confusion or dispute on how to account for certain issues. 2. If there is an agreement but it does not cover the given issue. In such case, the provisions of Indian Partnership Act of 1932 will be applicable. If you observe closely, you will see that the provisions of this act are more like common sense. The provisions are based on the intent and understanding of the firm and partners. Let's start with the first point, that is, if there is no agreement on how the profit or losses would be shared, the Indian Partnership Act provides that the same be shared equally among the partners. This will be irrespective of capital invested or efforts made or expertise of various partners. The profit and loss will be shared equally if the agreement is not there. Next, if there is no agreement on charging interest on capital invested by the partners, no such interest will be payable or will accrue towards the partner. Now here, observe that the capital is invested with an intention to earn profit on it. The investing partner understands very well that a business is subject to various risks, and so is his capital that he has invested in the business. Hence, it doesn't make much sense for a partner to get an interest on the capital on which he is already earning profit or expects to earn profit. No agreement on interest on drawings. No interest will be payable or charged to the partners on drawings. See, if the interest is not allowed on the capital, you will find that it's only fair that the interest is not charged on drawings as well. If the agreement doesn't provide on how to allow salary or commission to the partners, again it will not be payable or allowed to the partners. Observe the understanding part here. When partners can get into an agreement to do a business, they take a risk collectively. Now, allowing salary to a partner in this case may not be fair, though I think the point is debatable. The next important clause would be interest on loan. Now, if the partner invests as capital, his intent is to put the money for a very long period of time. However, if he extends a loan, the understanding is that it will be paid back in a particular period of time. What I'm saying is, though the funds are coming from the partner, in both the cases, the intention or the understanding with the firm are different. So, the Indian Partnership Act provides for interest on loan by a partner at 6% per annum, and this amount is charged against profit. Now, you may think, what is charged against profit? We will cover this in a while. Currently, focus on the above 5 points. This is an important concept. There may be situation-based questions in your examination on this. I would like to repeat, if the partnership deed is not available or absent, the provisions of the Indian Partnership Act 1932 will be applicable. Please learn the above 5 points. Let's solve some problems relating to the absence of partnership deed and agreement. Let's take an example of a partnership firm with three partners, X, Y, and Z, who have invested capitals of rupees 20,000, rupees 10,000, and rupees 10,000 respectively. However, there is no agreement on any clause between the three partners. Let's take examples of some cases in this scenario. Try to answer the questions that I will put now. If possible, write your answers down. I will provide the answers in a while when you can check them. Now let's take a look at the questions. X has invested more, so he demands an interest on the extra capital invested by him. Y devoted full time to the business, so he says he deserves a salary. Now X and Y both decide that their share in profit should be higher because one has invested more, the other is giving more time. Z doesn't agree to it though. Z gave a loan of 15,000 to the firm and demands an interest of 10% on it. Now X wants to introduce his son as a partner. Z agrees, but Y objects. X withdraws rupees 2,000 from his capital. Y and Z ask him to pay interest on drawing. Y got a big order for the firm. He demands a commission for his effort. You can pause the video if you like. I'm going to go ahead with the answers now. Remember, there is no agreement on any point among the partners. So, the provisions of Indian Partnership Act 1932 will be applicable that we have already studied. So, here are the answers. For the first point, no interest will be payable. Y is asking for salary, but it is not payable. No agreement is there. Now, equal share of profit and loss will be given because again, there is no agreement, means equal share of profits. Interest will be payable on loan by partner. We discussed this in the last slide at 6% per annum. Now, remember the point per annum. Per annum means this has to be annually. If the loan is given for 6 months, then he will get the interest for 6 months only. No partner can be added. A partner has the right to deny the entry of a new partner. No interest will be charged on drawings, so no interest. And again, Y got a big order, but there is no agreement on any commissions or salaries, so no commission will be payable. I would like to present a change scenario now to further clear the concept. So here's the same set of cases or questions with change scenario, that is now with agreement on certain points. Now before you start answering, watch closely the details given on the left of your screen under the scenario 2. The partners now have an agreement on certain points. you must know that a verbal agreement is also a valid one. Please pause the video if you want time to answer. I will now give you the answers with the change scenario. For point 1, there is a clause in the agreement allowing interest on capital at 8% per annum. So, all three partners will get the interest on their capitals and at 8% per annum. For the second case, there is now a clause in the agreement regarding the salary. So, Y will be given a salary of rupees 2000 per month, and this will be irrespective of how much work he has done. There is no clause for profit sharing, so the answer remains the same. Profit or loss will be shared equally. Regarding the interest on loan in case 4, there is a clause now in the agreement. So, Z will get interest on the loan at 8% per annum now. This is as per the agreement. Rest of the points are still not covered in the agreement, so the answers remain same as before. That is in line with the provisions of the Indian Partnership Act 1932. So here you would understand that if there is an agreement, then the provisions or the accounting is done as per the agreement. It is only when the agreement is absent that the provisions of Indian Partnership Act 1932 will be applicable. Now I spoke about charge against profit. Let us discuss it. Let us try to understand the concept. The partners earn profit from the firm. Profit is the amount that they have a full right on. This profit is what partners have for themselves. The distribution of this profit is called appropriation. But there are certain amounts that are payable to the partners even if the firm is not making profit. Such expenses are said to be charged against profit. Now, let me clarify the differences once again. Charge against profit and appropriation of profit. What are the differences? When an expense is payable, even if the firm is not in profit, it is called a charge against profit. Whereas appropriation can be done only if the partnership firm has made a profit. Appropriation is basically distribution of profit among the partners. There are various clauses that the partners may agree upon which outline the manner in which the appropriation would be done. Some examples will clarify this. The examples of expenses charged against profit are interest on loan by partner and rent payable to partner, whereas examples of appropriation include interest on capital or salary or commission. These are adjusted before the balance profit is shared among all the partners. I hope you got a basic idea of the concepts. The appropriation and charge against profit will be discussed with practical questions in next few classes, which will make the concepts even clearer to you. But just have a basic idea of these two concepts. Now before I end this session, I would like to discuss some scenarios regarding liabilities of partners. While working in a firm, a partner would develop knowledge and skills in its field of business. He would also have the right to use the assets of the partnership firm. Now, what if he tries to take advantage and earn himself some benefits? Let's have a look at the scenarios. What if a partner undertakes any activity or business that is similar or in competition with his partnership firm? What if a partner earns some benefit or commission because of a transaction done by the firm or for the firm and there is no agreement regarding it? What if a partner earns profit by using the assets or even the goodwill of the organization? The earnings so made by the partner will have to be paid to the partnership firm and benefit all the partners alike. This is again based on common sense and to protect the interests of all the partners. Please go through the three scenarios again. There could be a 1 mark question. The probability is low, but there could be a 1 mark question which will be an easy picking for you if you learn this. So friends, that's it for the first session, the theory and concepts part of partnership. In the next session, we will start number crunching as we take up the practical questions, which I personally find even more interesting. Now there are some questions in the end of the presentation you should be able to answer, and contact me if you have any doubts. My mobile number and email ID are given in the description. This is Amit Lawania signing off. Keep working hard.